Yeah, it's a stable day of trade. Nilesh Shah of Envision joins us now. Let's take the conversation forward with him to understand what he feels where markets are headed. Nilesh, good morning. Thank you for joining us. What is your view on the market? Looking at the way how globally things are looking slightly helter-skelter, do you think we've topped out for the year?
It's hard to kind of really have a prognosis that it's topped out for the year or not. But what it at least looks like that from an India standpoint, it looks like that the best is yet to come for rest of the year, because clearly what you're going to see post-September is a lot of positive news flow coming in because of a stronger demand environment back home, given that it coincides with the festive season, the marriage season. So clearly the period from October to December should actually be a comeback quarter for the economy and from a demand standpoint. So clearly believe that probably the best is yet to come for rest of the year. Again, I think globally, yes, there have been concerns recently in terms of the relapse of the virus and all of that. But clearly the liquidity environment is still very strong, very benign. Clearly, this rally has been led globally by tech. And they continue to be doing extremely well, the global tech companies. So to that extent, I would still not be entirely sure whether we've seen the peak for rest of the year. I probably still in the camp that the best is yet to come for rest of the year.
So what's been your portfolio strategy, Nilesh? Are you fully invested in this market? Are you putting some cash powder dry, given that the run-up has been more on P multiple, not on earnings?
Well, on an aggregate basis, we invested more than 90%. So to that extent, I think, yes, I think that really reflects our stance on the market. What we've essentially been doing is to kind of have a lot of our new inclusions from sectors like technology services, pharmaceuticals, building materials. That's really the space that we've been focused on. And I think that's what we think is going to be a pretty relevant strategy going forward, because the earnings momentum still is the strongest in these kind of pockets in the market. So clearly, I think from a portfolio strategy point of view, we have been focusing on a lot of bottom-up ideas in some of the sectors where we think there is a strong earnings momentum. And I think that is getting reflected in the fact that we remain constructive on the markets going forward, even from the current levels.
Nilesh, hi there, good morning. We've been seeing a lot of interest in some of these sectors like specialty chemicals, the agri/fertilizer space that has been garnering a lot of attention. Do you think that it would be a prudent strategy to look at these spaces closely?
Yes, clearly the global outsourcing opportunity is huge, clearly, undoubtedly. And of course, with some of the initiatives of the government here and a lot of the global developments, clearly global outsourcing is a huge opportunity for Indian businesses. And within that, clearly believe that there are four very strong pockets where global outsourcing really fits in well, where India can actually be part of essentially the global supply chain. And these are essentially, of course, the conventional technology services. Second is, of course, pharmaceuticals led mainly by API. The third is essentially specialty chemicals. And fourth, of course, is manufacturing and manufacturing around components and all of that. So these are the four very large pockets one can really kind of be focused on in terms of global outsourcing. And clearly within that, specialty chemicals, of course, is clearly a significantly scalable opportunity. But on the whole, we think that on a relative basis, clearly technology services, pharmaceuticals, is a relatively better opportunity to be in, because there is more visibility and consistency of relatively higher growth. It's less capital intensive. There is some bit of pricing power and all of that. And it's not just plain vanilla manufacturing that you set up a capacity and you get an order and you execute. It's not pretty much like that. So to that extent, I think on a relative basis, I think we would be more positive on technology services and pharmaceuticals versus the pure play specialty chemicals place.
Nilesh, a couple of months ago when we interacted with you, you had spoken about the PSU space as well being quite interesting, saying it's a very event-driven sector, high dividends, privatization, etc. All of that seems to drive news flow around this space. Do you continue to remain confident? Is this a sector that you'd be betting on?
I think there has been very limited progress yet on areas like divestment, privatization, and all of that. Of course, the intent is very clearly there. There have been those initial moves, but yet nothing seems to have been finally consummated. So to that extent, I still think that the visibility is yet very low in terms of these kind of developments. But nevertheless, there are pockets within the PSUs which are strong businesses on a standalone basis. So of course, while the events relating to divestment or privatization, of course, may unfold in the future, but I think one should still probably be very constructive on any of the pockets in PSU segment where there are strong businesses on a standalone basis. And these pockets, of course, are around engineering services or defense. These are some of the pockets where I clearly believe that some of the PSUs have a very, very strong competitive edge because of the fact that they have been in this business for years or decades. They have a very captive clientele in terms of primarily the government and the government-owned enterprises. So to that extent, there's a relatively stronger visibility in terms of the business outlook. So one should again look at bottom-up ideas in these two or three cherry-picked opportunities versus basically just buying a company because it is a PSU and may get privatized in future. That should not be the approach. The approach should be that on its own, on its merit, is this a fantastic bottom-up business to invest in from a medium to long-term perspective, and does this business have a strong competitive advantage?
Okay, fair enough. Nilesh, talking about some of these pockets, you've mentioned tech, you've mentioned specialty chem, etc. While I'm sure there is opportunity for the large part, there's also already been quite a significant run-up. How much more room do you feel there is? Or are you looking at this from a more long-term point of view, or just the more safer, attractive options right now?
Well, it looks like that, we probably believe that there is at least a strong visibility, at least for the next 2 or 3 years, which means visibility in terms of growth. We have to keep in mind that some of these sectors are coming out of a consolidation of several years, where for several years they probably just grew at best mid to high single digits. And of course, the sector like pharmaceuticals have had regulatory challenges in the past. And of course, earlier on did not demonstrate the kind of scale that they have now been demonstrating on the API side. So what it looks like is that these are sectors which probably are well poised for essentially a growth for at least the next 2 to 3 years. And we've seen this even in the past, that when a sector does demonstrate or a company does demonstrate a sustainable double-digit kind of earnings growth, backed up by relatively stronger or a relatively higher capital efficiency and improving capital efficiency, then the case for re-rating in a way continues, it sustains. We've also seen in several cases in the past that the P multiples actually kind of then get into a bubble territory. What it looks like is that it's still relatively early days. I of course can't say that this is the start because yes, like what you rightly said, stock prices have moved up quite significantly. But I still probably think that from an overall opportunity standpoint for investors, it is still very early days. And maybe this is an opportunity which is going to last for another 2 or 3 years. One has to, of course, keep in mind that some of these businesses have benefited by a relatively weaker currency, that versus a currency which was more like 69, 70 rupees for, say, sometime last year, versus that we are now at 73, 75 kind of a range. In this year or in recent times, and that of course has been a significant tailwind for these businesses, and this is essentially pretty much like a windfall that they've had. So one has to only just be a little careful or cautious on that front, that if the rupee were to kind of get stronger and the dollar to get weaker, then they might have some dampening effect in terms of their earnings outlook, especially for technology services where the intrinsic growth is still in single digit. And so to that extent, they will need the support of a weaker rupee and a stronger dollar to kind of post that double-digit kind of growth. Versus that, I think sectors like pharmaceuticals or specialty chemicals, or maybe even conventional manufacturing, they have slightly more pricing power. And so to that extent, they don't need the support of the currency as much as what a technology services sector needs. But otherwise, on the whole, on an aggregate basis, these are great businesses to be in from a 2 to 3 year perspective, notwithstanding the fact that, yes, prices have moved up over the last 2 or 3 quarters.
Okay, fair enough, Nilesh. And when we're talking about the cyclical part catching up, when we're talking about construction, for example, and everything related, how far do you think we are from that? Because after that initial anticipation, there's been a feeling of a lag or some kind of some kind of a lull, really. Is that more perception? Are you seeing it already happening on ground? What's your sense?
So you probably still think that these are early days to really gauge whether the economic activity, especially in sectors like the construction sector, is back to pre-COVID or not. And that's purely because it was never expected to kind of get back to pre-COVID levels by September, because clearly this essentially is a period where the monsoons are still underway. That in a way hampers construction activity. There is, of course, an issue of the migrant laborers as well, and a lot of them have chosen to stay back because obviously the need to be on their farms and take care of that activity. So there's a lot of seasonality where anyway economic activity and activity in areas like construction remains relatively tepid till about September or maybe early October. It's only when October sets in is the activity kind of gathers momentum and gets full swing. So my thought would be that, yes, it's not yet gone to the pre-COVID levels, but I probably would still want to wait for a period like October to kind of make that final assessment. Of course, there are some things which have essentially been done. So, for example, there have been some governments which have cut stamp duty. There has been some softness in real estate prices, which I think is driving some bit of demand. In addition to that, interest rates, of course, are relatively low. So to that extent, I think there are some tailwinds for the activity to kind of resume sometime in October. But I think one will have to probably wait for the actual data to really figure out whether activity is back to pre-COVID levels or not.
Nilesh, in your book, where does value investing go now? Buying stocks which are cheap, strong dividend yields, steel, cement, metals, ITC, will that come back ever?
Looks very unlikely, and I'll tell you why, Nikunj, because I think we've now, decisively moved in an era where capital is cheap. Look at what has been the mainstay of all these sectors which you mentioned. Of course, ITC, I would probably take it out from that. But all the other sectors, clearly the key driver was basically capital and cost efficiency. And now, of course, with capital abundantly available and cost of capital virtually at pretty much an all-time low, that kind of edge is really gone away. And I think clearly the preference is gone towards businesses which is more driven by human capital rather than financial capital. So it's clearly human capital, the intellect, and therefore that's how you weigh and the ability of businesses to create, to some extent, entry barriers or sustainable business models driven by essentially the human capital and the intellect. And the ability to therefore have higher returns on capital essentially is there. So to that extent, clearly the world seems to have moved away to an environment where the ability of a business to basically create a model which is global or pervasive and can get in with the least amount of capital. I think clearly we've moved decisively into a world like that. So clearly it looks like that the conventional definition of value investing now seems to kind of be probably behind us. Of course, in addition to that, the economic activity and the GDP growth rate in the recent times has, of course, also been very weak. So to that extent, the demand for cement or demand for steel and some of these products and sectors has been tepid or weak. So to that extent, the operating leverage is also not yet coming in for these kind of businesses, which have built huge amount of capacity. Of course, if we kind of get back to kind of an 8-9% kind of growth rate, or maybe even 7 to 8% growth rate, and there is massive growth in areas like infrastructure, then of course you're going to see a stronger demand. But that's something which could probably again last for a few quarters. There could be that initial burst in stock prices, but I'm not very sure if these are going to kind of give you long-term linear compounding returns.
Nilesh, what are the chances this time around earnings season may actually act as a trigger point for markets to top out? Because last earnings season, nobody expected anything. Little bit of recovery galvanized the market. Now everybody is expecting things would be normal by December, if not December by March, if not by March by June.
No, I think that's a very valid point. But I still think that most people still are basically expecting the recovery to only start post-September, which essentially is the December quarter onwards. Clearly, till September was expected to be a washout, of course, not as bad as June. And what it looks like is that the September quarter is unlikely to be as bad as the June quarter. The question is that can the September quarter at least be as good as the March quarter, which had, of course, a 10 to 15 days of a lockdown, versus that July to September, there has really been no national lockdown. There have been, of course, local lockdowns. So my sense is that if the September quarter turns out to be as good as a March quarter, then I think that should be fine. The street should take that more from a positive kind of a perspective. But if the September quarter is not as good as the March quarter, then of course that will act as a very strong headwind for the market. But otherwise, in terms of a full-fledged recovery, I still think the market is kind of betting on a post-September period for a very strong recovery in terms of individual businesses.
One to do in this kind of an environment. There were some opportunities as well to nibble into the markets on the declines. Would that be a prudent strategy, or does one wait it out for a decisive crash in the markets before entering?
No, this I think remains a buy on dips market. One needs to essentially keep accumulating your chosen set of stocks and use price declines to basically buy into them and keep constructing a portfolio from a 2 to 3 year kind of an outlook. Yes, in the short term, there can be speed breakers and there could be corrections. Corrections can't be ruled out. But I would probably still use those as opportunities to basically buy and look at them as more suitable entry points for your set of stocks. So I think on the whole, on an aggregate basis, this essentially market remains a buy on dips market.
Okay, fair enough. That's the buy on dips kind of a market. That's what you're advocating. What about the sense that you're getting then when it comes to the real estate space, largely due to the impact on commercial as well as residential real estate? One had sort of written this sector off. Do you think that there is merit in now relooking the real estate sector, Nilesh?
Yes, clearly the commercial real estate, of course, right now I think is probably the last place to be in. Clearly work from home is now becoming an accepted kind of a practice. So to that extent, I clearly think that the commercial real estate, of course, is going to face significant headwinds going forward. And of course, what is essentially been bad for commercial real estate, I think should end up being good for residential real estate. And you're going to see individuals and families wanting to kind of move into slightly larger homes where they can essentially work from home, earn from home, learn from home, and probably even entertain at home. So to that extent, the need for slightly larger houses and larger homes is going to be there. So to that extent, we would be more constructive on residential real estate versus commercial real estate. And one way, of course, is to buy into some of the residential realty players. The other is to also kind of look at some of the companies which are into building materials, so companies which make tiles or which make sanitary ware or which make some very basic, home appliances. This essentially is also one more way to kind of be there in the residential real estate space.
Okay, Nilesh, got to just touch upon all the global action as well and get your sense on how much you're really building that in. We've seen, some net sell figures starting to come in as perhaps we're counting down to those elections. How big a part do you feel it's going to play in the volatility of the next couple of months?
Yes, that surely is going to be a source of volatility for global markets. Clearly, it's a divided camp who essentially is going to be the front runner and who's essentially going to be winning it. And there are different kinds of news reports which keep coming out. So to that extent, clearly that will have a significant bearing, both in run-up to the elections and post the elections. And I think and I'm no expert on US elections, but I think there's also a thing that you may have a particular candidate who probably wins the election, but whether he would finally be able to be the president because of how the Congress is essentially organized. So to that extent, I would definitely think that there is going to be some bit of a divided opinion, divided views, and some bit of uncertainty as well before the election and post the election itself. So clearly, I think for rest of the year, that would surely be a huge source of volatility for global markets as we move closer and closer to the election.
All right. Thanks so much for joining us this morning and taking us through your views, Nilesh.
Pleasure. Thank you so much.